legendary investor John Bogle manages more than $1 trillion. Chances are, some of that money is yours.
Find out what he says works for everyday investors. That's next on MoneyTrack.
MoneyTrack is made possible by the Investor Protection Trust. The Investor Protection Trust is a nonprofit organization devoted to investor education. Over half of all Americans are now invested in the securities markets, making investor education and protection vitally important. Since 1993, the Investor Protection Trust has worked with states across the country to provide the independent, objective investor education needed by all Americans to make informed investment decisions.
This is MoneyTrack. Your guide to investing and protecting your money. This is MoneyTrack.
Hi, everybody. Welcome to Season 2 of MoneyTrack. I'm Pam Kruger.
And I'm Jack Gallagher. Our show is about money, how to make it and how to keep it by investing it very carefully throughout your lifetime. You know, so much has changed over the last year and a half. We're paying a very high price now because of a lack of oversight and integrity on Wall Street.
And let's face it, just plain common sense on the part of ordinary Americans who took on way too much debt.
And that leaves a lot of people very skeptical about investing their money in the stock market.
You know, the crisis is taking investing opportunities away from us and created brand new opportunities, but we can't recognize those unless we understand the basics of investing.
So, on MoneyTrack, we introduce real people whose stories show us what works and what doesn't work when it comes to investing. And in case you were wondering, Pam has a background as a stockbroker, and frankly, I don't. I'm here to make sure that Pam and all our other experts don't get too far over our heads. And obviously, I'm the eye candy on the show, and the only one that usually thinks that. So we're not your typical business show. By the way, this is Pam's dog, Chloe.
Yeah?
Chloe's job on the show is to remind us to keep it real, to keep it relaxed and
exactly.
calm. Right.
So let's get started right now with the big picture, with a history of Wall Street.
Riding the stock market sometimes feels like this. Recently, that ride's just been a terrifying plunge. But even in the market's darkest days, it has always given investors a ride back to the top, even during the Great Depression that started in 1929. By 1932, the market lost 83% of its value, and it was a long, cruel 10-year stretch before investors got paid back. But
if you had kept your money and not been influenced by the emotion of the moment, perhaps you would have done very well.
It happened a few times after that, too, in 1987, then with the tech boom bubble bursting in the 90s, and each time, the market came back.
One of the great messages that came out of the crash of '87, this is not a time to necessarily panic and pull your money out of the market, but that markets go through natural cycles.
But it's all this volatility that makes the stock market feel like a giant casino. Taking time to understand the basics can ground those emotions.
All you need to do is take the time and put in the effort to know where your money's going and that you're comfortable with your investments, and it's not the same as laying it on the table and letting the dice roll the way they may. Even if you've got somebody managing it for you, you still need to know what they're doing and keep track of if they're making you money or not making you money at a bare minimum.
Even if you're committed to stocks for the so-called long haul, it still seems a pretty scary place to do business. But buying and trading stocks is how American companies find the cash to create new products and jobs. What happens on the trading floor here affects everything from your work to the home you buy. My friend Brandon is getting his first real lesson on the basics of investing in stocks.
Yeah, what kind of games do you play? Do you have games at home, maybe?
PlayStation 2.
PlayStation, that's made by Sony, right?
Can I get shares of Sony?
Well, sure you can.
Wall Street got its name a few hundred years ago when they grazed cows and farmed. They needed something to keep them from escaping, so they built a wall and called it Wall Street.
The New York Stock Exchange has a wonderful history dating back to 1792 when a group of 24 stockbrokers got together. They were trading stock on the street, and they signed an agreement stating that they would only work amongst themselves, created a private club.
That private club wasn't private for long. Wealthy and well-off investors started buying and selling shares of each other's companies, and the New York Stock Exchange arrived. Wall Street Journal and the Dow Industrial Average came to be in the late 1800s, Still, only the wealthiest Americans were investing back then. It was not until more of us had disposable income that more everyday families and individuals started investing, and later buying mutual funds in the 70s and 80s, and index funds from the 90s till today. NASDAQ is the other big stock exchange. In fact, it is the largest electronic stock market in the world.
Well, Andy, there's no big trading floor here. Investors buy and sell everything online.
In fact, that's the way they trade virtually everything these days.
We just executed the trade.
The question is, do we still need all these men and women auctioning stocks in person when you can do it all online?
20
A lot of the business that we do here is already electronic, but yet we still have a very active trading floor with brokers representing clients because many of the clients want the value added that a broker can give him.
But NASDAQ thinks we no longer need trading floors.
Now every market in the world will be electronic. Every market in the world will trade electronically and bringing the ultimate buyers and securities directly together.
The average investor doesn't really care how the trade happens. They're more concerned with the commissions they pay, or if they're buying options, stocks, mutual funds, or just purchasing a small piece of the market, or all stocks traded in something called an index fund or an exchange-traded fund.
Rather than try to pick one company over another, he will buy the ETF that represents that sector. And so if the sector turns out to be good, the ETF will reflect that and go up in value.
So many people aren't certain where to invest with an uncertain economy. But one thing hasn't changed in more than 2 centuries on Wall Street: finding good companies that make products people need or desire. Historically, their stock prices and dividends rise right along with those companies' earnings. It's a reassuring constant in a rapidly changing economy. In New York, I'm Andy Field for MoneyTrack.
A couple of things that made me think while I was watching that piece. For one, I did hear index funds mentioned, and that's a term that I've heard tossed around a lot.
That's right. So, perhaps grasshopper. This makes a good quiz question. This week's MoneyTrack quiz question is, what is an index fund?
Is it A, a mutual fund that invests in index cards, B, a fund that invests to keep up with the cost of living, or C, a portfolio of investments that is weighted the same as a stock index so that it mirrors the performance of that index?
Now, those are your choices, and we'll give you the answer in just a bit.
You know, getting back to Wall Street, the other fact that got my attention, it's almost always wealthy people who bought stocks way back when.
That's right. Now, more than half of us are owners of mutual funds in some form or another.
Right, and the fund concept actually took off, correct me if I'm wrong here, because average people like me, working people, don't feel like we know enough to invest in the right stocks, right?
Exactly. So instead of racking your brain to figure out which companies to invest in and to buy, when you buy into a mutual fund, you're investing your money into a bigger group of stocks or bonds alongside millions of other small investors just like you. And it's the professional money manager running the fund who has to then analyze which stocks to buy, sell, or hold on to.
And I basically just go along for the ride. Now, I have to admit that I own some funds, but I don't feel really connected at all to what's going on Wall Street. But I have to keep remembering that a piece of my net worth is there.
Exactly, because just about anybody in this country who has a job has a direct link to the stock market thanks to 401k plans. But in between you and those companies whose stocks you actually own are layers and layers of other people.
Right, like in the typical 401k plan, you've got a human resources person who then goes through a pension administrator.
And then that person goes to a broker who then invests your money into the mutual funds you selected in your plan. And this is important, by the way, all those middlemen have to get paid.
Still, in the end, my 401k money is on that stock market roller coaster that we saw earlier.
For better or for worse.
For richer or for poorer.
Afraid so.
You may kiss your investment.
That's right. Hopefully not goodbye.
Yeah, exactly.
Here's the good news. Hanging on for the full roller coaster ride has paid off big, to the tune of about 8 to 10% growth a year. And that's historically over about the past 70 years.
And now every week on MoneyTrack, we like to hear from you. And today we have a question from Dorothy. She's at Cafe Portofino in Boone, North Carolina.
I have all my money invested in CDs at the bank instead of the stock market. Isn't that okay, having CDs in the bank? Why should I have all that risk in the stock market?
Okay, we're calling in the big guns to help us answer that question. As promised, Mr. John Bogle, one of the world's greatest investors and founder of one of the largest and most successful mutual fund companies, the Vanguard Group, is joining us now.
John, it's great to have you with us. Dorothy's asking, why risk money investing in something that goes up and down when you can just get a steady, solid, say, 4% at the bank? Why bother with stocks?
Look, Jack, let's think of the real arithmetic of these two different kinds of returns. If a savings account pays you, say, 4%, and we have a cost of living increase of 3% a year, you're getting 1%. Put $10,000 in the savings bank, and you end up with $14,200 at the end of 35 years. Now, let's assume you put it into the stock market, get a 7% return. We'll now take that same 3% out for the cost of living, which is going to give you a 4% real return. Your $10,000 investment now grows not to $14,200, but to $39,500, almost 3 times as much, just for taking that little initial risk, but not taking nearly as much risk that inflation will eat up your savings.
So, John, by losing 3% a year just to inflation, it's actually riskier to put your money under your mattress and lie down on it than it is to participate in the stock market?
The biggest risk is not investing.
Well, thank you, John Bogle, and we will hear more from John a bit later in the show.
Yes, and it's one thing. It gets me thinking. If I want to go out and spend 3% of my savings every year, but it's another whole thing to just let the money erode because of inflation.
Just let it evaporate.
Exactly.
Okay, let's answer a MoneyTrack quiz question right here, right now.
All right, today's quiz question is, what is an index fund?
And your choices were A, a mutual fund that invests in index cards. I don't think so. B, a fund that invests to keep up with the cost of living. Or C, a portfolio of investments that is weighted the same as a stock index so that it mirrors the performance of that index. Well, we decided to invite someone special to our show today. Shauna Kroom is from one of our very favorite investing websites, Investopedia, and that is exactly what it sounds like. It's an encyclopedia for all things about investing. Shauna, welcome.
Hi,
and
Shauna.
How about the answer to today's questions?
Thanks, Pam and Jack. The answer to today's quiz question is C.
Yes, I kind of
you did well.
Thank you
he
very
did
much.
well on
Every
that
once
one.
in a while.
That's right. An index fund is a type of mutual fund that tracks the stock market or a part of it. For example, the S&P 500, this is one of the best known indexes. It tracks 500 of the largest companies in America. So, if you purchase an S&P 500 index fund, you've essentially bought the Pfizers, the Microsofts, all the big companies in just one investment.
So this one investment gives people instant diversification, which takes all of the work out of having to go find the stocks to spread the risk.
That's right.
Okay. Now, we mentioned exchange-traded funds a minute ago, too, and we promised we'd explain any jargon. So an exchange-traded fund or an ETF, the difference between it and an index fund?
An ETF is essentially an index fund that trades like a stock.
So in other words, that on a daily basis where you can only buy and sell an index fund like a mutual fund once a day, these you can actually trade like stocks if you wanted to.
You can trade throughout the day. That's right. And if the value changed throughout the day, so let's say the S&P 500 is trading high in the middle of the day, you can capitalize on those gains. Whereas with a regular mutual fund, you're going to get the end-of-day price regardless of when you bought or sold it.
Right, but put duct tape over my mouth. You didn't hear that because we don't like to tell people to trade. Let's segue for a second to something that ties together what we've been talking in the show today.
This is really cool.
Is there an easy way to organize all of this in sort of a way you can see which kind of risk you're taking?
There is, and it is as simple as drawing a triangle. And let me just see, this is an easier way to see it here. At Investopedia, we have this great tool. It's called the Investing Pyramid. It's as simple as drawing a triangle, dividing it into thirds, as you can see on the screen here. At the bottom part, you'll notice that the base is the largest.
Right.
Now, as our caller in North Carolina mentioned, she had all her money in CDs. Her investments would fit in this bottom portion. But as John Bogle so wonderfully illustrated, you don't want to keep all of your money in there. Now, in this investing pyramid, as you move up, your risk increases, as does your potential return.
If you imagine that you take all of your money, everything that you have, you take the money from your checking, you take it from your 401k and from your wild investments in oil and gas futures, and you were to stuff it all into this pyramid, it has to go someplace, and by the time you're done looking at how much risk you're taking with each investment, it gives you a snapshot of exactly how much risk you're taking.
You can really visualize where your risk is in your current investments or where your investments maybe should be. As the caller just mentioned, her investments entirely in low interest CDs are right at the very bottom. She's missing out on all of these other investments up here that could increase her return and have a, when you retire, you'll have more money that way.
So you want to have the majority of your money in the foundation.
That's right.
You want to have some of your money in the middle, because if we have it all in CDs at the very bottom, we're just getting the lowest amount of interest or the lowest payback, and that doesn't keep up with inflation.
Give us an indication of what would be in the Summit.
The Summit, this is your speculative stocks. These are, brand new penny stocks. They could be a big break or they could be a bust.
Something you feel like you can play around a little bit.
That's right. That's right. You know that if you've answered most of these questions and, hey, yeah, I have quite a large percentage here, you can determine where your risk tolerance is, and maybe you can also determine maybe you've taken on too much risk.
We were just talking about the index funds. Show us where an index fund would place on the pyramid.
The index fund would live somewhere in between the middle and the base section. Although it contains stocks which are up higher within this middle section, it's diversified. But through diversification, you limited that risk of individual stock
so it
investing.
moves it down a little bit on the pyramid.
That's right.
So you're not betting on just one stock,
No.
you're betting on the whole market.
That's right. I mean, these are the big companies in America.
In this case, the index funds, and we're not trying to suggest everybody should buy an index fund, we're just showing you that an index fund kind of grounds the whole process of investing in stocks.
That's
It's almost
right.
could be considered that you're getting the best of both. You're getting some stocks, you're getting a lot of diversification, and you're not taking as much risk.
That's right. What we've put here is a general guideline. You don't have to have those exact proportions in there. All in all, I mean, this is such a great tool. I think it'll be a really great benefit.
Yeah, this is an amazing tool, Shauna.
And we thank you so much for joining us today.
Thank you both.
Now, today's show is about simplifying the whole process of investing. And we know that mutual funds are a convenient way for busy people to own stocks.
And index funds take that idea one step further.
John Bogle is one of the best known investors in the world, and he's back with us now. John, your idea was to create a brand new type of mutual fund where once you buy it, you're pretty much done?
My rule for investors is buy the entire U.S. stock market, hold it forever, and above all, don't peak. Never look. And you'd be amazed you will be amazed at how much money you have at the end of the period.
See, I think it's my emotions that get in the way, these dreams of making tons of money in the stock market, or my deepest fears about losing it all in the stock market. Now, along comes the index fund, which sort of takes the emotion out of investing.
Think about this for a minute. When the stock market is at its peak, the very day it reaches that peak, optimism is at its all-time peak as well. That's why the stock market is high. We're all optimistic about future prospects. So stocks are very highly priced, and that's when you want to buy. On the other hand, what happens when the stock market hits a low? Pessimism is rife. People are scared to death, and that's when the temptation is to sell. So consider the picture. You're buying. Your emotions tell you to buy at the top. Your emotions tell you to sell at the bottom. That is not a good idea. Eventually, you won't have any money left. So what do you do about that? I think what you do is try and have a little balance in your portfolio of bonds, of all things. So when the stock market goes down, you'll have a little anchor of stability, an anchor to windward in the form of a stable bond account, which will produce some income for you.
What about costs? We haven't mentioned that fact yet. You have to subtract all the commissions and the fees that those middlemen make, whether it's a broker or whether it's a mutual fund. Now, index funds seem to cost next to nothing to buy. How is that?
Because the index fund takes the cost out of investing in the market. You don't need any money managers. You don't need any security analysts. So the index fund can run at somewhere less than 0.2% a year and maybe less than even 0.1%. So you can really capture the market's return, and it turns out that's a huge accomplishment.
John Bogle, thank you for letting us pick your brain today.
He really is the champion of the everyday investor. Now, you can look for more insights from John Bogle on our website. Go fetch that address, Chloe. Look at that dog go. You know, Pam, I always assumed that I could never really understand how to be a successful investor. Everything seems so overly complicated, kind of over my head, and it really, when you get right down to it, doesn't have to be that way.
Nope. And the truth is, if you truly do not understand how an investment really works, where your money's going, who's in control of it, you don't want to get involved.
Yeah, and now we're hearing a lot about another type of fund, right? The hedge fund. What's the deal with the hedge fund? Everybody
Very cool.
seems to want to be in a hedge fund. Why are they so glamorous?
Well, because hedge funds are perceived as being reserved for the rich and the famous. It's kind of like being a member of the club. And unlike a mutual fund, hedge funds are often offered by private partnerships, so you really do have to be invited.
Yet, you're still pooling your money with a lot of other people.
That is true, but here's the big difference. What the operators do with your money in a hedge fund is much less regulated, almost secretive. The idea is that they promise to make money whether the market is going up or down, and that's why they call it a hedge. And it really is a seductive proposition.
And the initial investment they ask for is big.
It is.
You know, Pam, I'm always interested in what Ben Stein has to say about money and investing. So, Ben, hedge funds. Are they really all they're cracked up to be?
Hedge funds are all the rage nowadays, especially for upper bracket wealth holders, and there have been some that have had fantastically good results. I think if you're a very sophisticated investor and you are dealing with terribly smart hedge fund managers, of whom there are some, you can make some real money with them, and you can get way ahead. But there are a lot of crooks out there. Unless you're terribly sophisticated, you would do well to just follow Mr. Bogle's advice and just buy a whole bunch of different index funds, lump them all together. You'll have some bad years, but over long periods of time you'll do well. Hedge funds are very trendy, but I've seen them come and go, and unless you are really, really, really well informed and have done your homework, stay away.
Well, there you have it. And Pam and I know one example of a hedge fund promise gone bad.
Yep, and this hedge fund story involves outright fraud that some very wealthy and well-known people got caught in. It is this week's Scam Alert.
Former NFL safety Blaine Bishop delivered a lot of hard hits in his 10 years in the NFL.
The man in the spotlight was Blaine Bishop.
But he took an even harder hit last year, and this one really hurt.
Oh, it's 7 figures. So, 7 figures is 7 figures.
And Bishop wasn't the only NFL player who lost that kind of money. It happened when 6 players signed on with a slick-talking hedge fund manager from Atlanta named Kirk Wright.
Guy, Harvard grad, and, he sounded like he was on top of everything.
Wright seemed to have all the right stuff. Handsome, articulate, and very sophisticated about finances, all of which helped him lure hundreds of high-profile investors into his so-called hedge fund pool, which in reality was
high risk, high gain, but potentially high loss.
Georgia securities regulator Kevin Moore says, ironically, hedge funds started out as a way to lower risk by hedging multiple investments against each other. The thinking was, if one loses big, another might win big. But along the way, the hedges got trimmed.
Hedge funds today are more like edge funds. They run out on the edge, and they look for opportunities to make significant gains in highly unusual, non-traditional investments.
But nothing stood out as unusual to the ball players who invested with Wright. In fact, their hedge fund investments seemed to be doing very well. Wright sent regular statements to investors claiming a whopping 20% annual return.
I didn't find a reason to doubt it until, I asked for a withdrawal. And he gave me a check and that didn't clear.
So, who to blame? Well, because the Players Union had given Wright's hedge fund the seal of approval, Bishop and the 5 other players filed a $20 million suit against the NFL and its Players Association.
We gave our lives for them when we were hurt, out there playing, injured, and they told us this program was supposed to protect us, and in the end, did they really do their job? It's obviously that they didn't.
Kevin Moore tells MoneyTrack it's a simple case of something called affinity fraud.
Affinity fraud is when you're lying, cheating, and stealing to people who identify with you.
In this case, the common bond was a group of victims who were wealthy African-American athletes.
I never thought about that, to be honest. He was so sharp and intelligent and so good at manipulating people.
Jack, one way those players could have avoided all of this Whenever anybody offers any kind of investment, just phone or email your own state securities regulator. Every state has one, and he or she can tell you whether the deal is real.
And we can make it easy for you. Just go to our website. That's MoneyTrack.org. Click on Scam Alerts and look for the link to your state regulator.
Well, we have picked up some valuable insights today from the man who created the index fund, John Bogle. He reminds us that investing can actually be a simple process and that we have to consider what it costs to invest because those costs have to be subtracted from whatever we make.
Shauna from Investopedia showed us a very cool tool. The risk pyramid makes it easy, simple to figure out how much risk you might want to take on when you invest. And again, it's right on our website.
And finally, there is no magic that makes a hedge fund a great investment, and there are ways to investigate before you invest. That is our show for today, and thanks for being with us.
So long, everybody. See you next time.
Pam, Jack, you know any of that? Kruger.
The whole secret with the pyramid is at the bottom, your real low-risk stuff, and then as you go up, bigger and bigger risk till you get to the top. You don't want to have a lot. Are you listening to me? Look at me. I tell you this stuff all the time and you don't listen. If you listen to me, you'd have a much nicer collar. Believe me. Yeah, fine. You know everything.
Gallagher.
Brandon, with all the changes that have been made over the last... Brandon, with all the changes in Wall Street over the last...
Okay. I could do it all myself online.
Just throw that "and" word in there for both things.
I could...
So you say...
Okay.
What was the first thing you say? Really hit the money track at the end. Go, for MoneyTrack.
For MoneyTrack.
Very good.
Yeah.
That was good.
Okay.
There we go. 3,